This show is produced by the Hartman Media Company. For more information and links to all our great podcasts, visit hartmanmedia.com.
Welcome to the AIPIS show for accredited income property investment specialists and those who aspire to be. If you're a real estate, mortgage, or financial professional, this is the place for you. We'll explore innovative investment analysis, sales, marketing, and income-generating strategies for the most historically proven wealth creator, income property. Learn from the experts as they show you how to build a better business and a better life.
Welcome to this edition of the Mortgage Minutes. We are joined by one of the lenders in the Jason Hartman Network, here to talk about what all is going on in our world of lending. How are you doing?
Not bad, man. What's shaking with you?
Oh, just trying to buy another property in the next future. So let's talk about, for our investors out there who are looking to buy a new house right now, new investment property, if they're looking at a $100,000 house and they've got 25 or 20% down, what can they look forward to seeing whenever they get your estimate?
Well, the average individual I've been working with lately in that range seems to be 740 plus credit scores pretty commonly, and I've locked a lot of those deals lately. I've locked many people at about 4.75% for that 20% down $100,000 acquisition. And then I had some that elected to do the 25% down, and that happened to come in at 4.25%. So it seemed like a much bigger gap between the two than what I'd seen in the past.
Nice. Now, we've been seeing, obviously, the Fed has been doing their cuts, and there have been talk about, the U.S. potentially. I think Janet Yellen came out recently and said, 2020 might be rough. Is the Fed's unease with the economy and people like Yellen's unease with the economy, how is that impacting the rates that we're seeing right now?
Well, it had a negative impact to the rates just in the last little while. So at one point we did see rates get, they were low like they are now. Then they actually went up for probably about 2 weeks. And then recently in the last probably week and a half, they got right back down to where they were previously. And a lot of it is with the Fed rate cuts was actually kind of giving some concerns of it being an inflationary environment. And when we have inflation go up, it means, the dollar is declining in value. The places where we go to get our money, the mortgage-backed securities, those who invest in those mortgage-backed securities like pension funds and retirement funds and 401ks and IRAs and mutual funds, all those that are putting their money there, they're not big on a long-term instrument when the instrument they're being paid back with is losing value at a rapid rate. Now, we all know with inflation anyway, it's already losing extremely rapid rate, but the Fed's, tickling those numbers and trying to keep them within 2%, and there was some inflationary concerns, and that's what spiked that. Also, in that last couple of weeks, you noticed that the stock hit the all-time high again. Or actually, not really even again, it just reached another plateau. So there's also a lot of money being sucked over to that, even though it doesn't make any sense. It's still being pulled over there. And so every time you start getting a jump in other instruments such as equities, you'll see long-term instruments like bonds suffer for a little bit. And then, investors will calm down. The heat will get a little bit cooler again in the markets, and they'll work their way back to those long-term safer instruments. So the economy worry is out there. I think one of the other things I believe will help interest rates going forward, that there's a lot of conversation about, because of the state of the economy, of the Fed warming up that quantitative easing again.
Yeah, I was laughing to myself whenever I saw the stock high, and it made me think back to the turn of the century whenever people were saying, I think that book came out, it was Dow 30,000. And still waiting on that one.
I remember when the Dow hit 10. That was a big damn deal. It was my first year in the industry, 1998. When that happened, I got in the end of 97, so I'm 22 years in as of next month. And I remember when it hit 10,000, everybody's running up and down the corridors of this courtyard of this company, of this office building I was at. I'm like, what's everybody dancing about? The Dow hit 10,000. I'm like, I don't know what that means. And so now we're knowing what that means, and I'm shaking my head all the time. I can't believe we're even remotely knocking close to 30,000.
What are you thinking is going to happen in the next couple months? Like if the worst fears come true and we see a recession starting in 2020, what are your thoughts on how the rates will react and how much they might swing?
I believe we're going to be continued on a trajectory of lower interest rates. How much is kind of hard to say. To me, it's insane that we're even as low as we are. But what I keep telling all my real estate investors I work with, doesn't matter anywhere, whichever way they swing, this person is still going to benefit significantly with where they're at. Because it's kind of hard to believe that they'll get much higher than 5 to 5.7%, like where they peaked out in the last 24 months. And even at that, we had shown with the tax deductibility and the other benefits in the inflation environment we live in, that the interest rates, even if they did swing up, does not really hurt the real estate investor. The homeowner, yes. The real estate investor has very, very, very small movement when you start factoring in all the things associated with their benefiting of being the most tax-favored asset class on the planet. They take advantage of inflation to offset compound interest. All those things play in their favor regardless of what the rate is. But I still believe the interest rates are going to go down based upon what I'm hearing and the various economists that I subscribe to. And if that's the case, take advantage of the situation. And if the recession comes and forces some housing issues, all we're going to do is create a larger pool of renters for us as investors to be able to give opportunities of housing to. And then we might even see cheaper housing again in certain markets because of, isolated bubbles. I'm always bullish on especially a recessive economy.
Now, obviously, investors have a tendency to not necessarily worry about the slowdown or pickup of home inventory necessarily. But have you been seeing more mortgage starts coming in or fewer, or what's your kind of velocity going on?
Me personally, I know we've seen a lot of slowness, or at least things slow down a little bit in the industry as a whole. Mine's been growing. I closed 83 transactions last month, or was it 84, something like that. We're putting on my team at least, we've seen as many as 10 contracts a day pretty commonly. So we're not slowing down. We're continuing to gain momentum.
If we compare the 83, 84 to maybe what you were seeing in like May or June, kind of where are we in that regard?
Very similar. Okay. It's been pretty heavy trajectory. We got a little bit more going on right now because we as an organization in the last 6 months sat down as a company and we got with the board and we started digging into the margins and everything and really started figuring out where can we be rate-wise compared to the rest of the market and be able to service our clients and not be in a negative position, but also give them the best that we can possibly find. And since those days, sitting in the boardroom with the executives of this organization and talking with those who buy our loans from us and the capital markets division who services our loans, and we found that sweet spot, we did see an increase, a rather significant increase once we started to be able to offer the best that we can find and the margins that we can cut down and really make sense of and still be profitable, but not at the expense of our clients. And we have seen a large, large benefit to our pipeline as a result of that. So I can honestly say that we've seen a huge uptick in the last probably 4 or 5 months. So June's when it really started to get traction, and then it's been nothing but really cranking since.
Well, that's fantastic. Is there anything else you want to say to the investors and listeners out there?
Just keep your minds open exactly what you're looking at. As far as the people you're working with, it's all about the groups you're working with, the individuals who are helping you achieve it, not so much about all the other things that are happening in the economy. The economy is designed to benefit you more than you can realize right now. It's not something you can be able to figure out until down the road. But, secure great people to work with, and that will change the dynamics of your business.
All right. Well, until next time, keep closing.
Thank you so much for listening. Please be sure to subscribe so that you don't miss any episodes. Be sure to check out the show's specific website and our general website, hartmanmedia.com, for appropriate disclaimers and terms of service. Remember that guest opinions are their own, and if you require specific legal or tax advice or advice in any other specialized area, please consult an appropriate professional. And we also very much appreciate you reviewing the show. Please go to iTunes or Stitcher Radio or whatever platform you're using and write a review for the show. We would very much appreciate that. And be sure to make it official and subscribe so you do not miss any episodes. We look forward to seeing you on the next episode.